that is 60. Now, looking at the next journal entry, you've number 7, equity in earnings of investee. That's 25. And that relates to the investment under the equity method. Even that has increased by 25. So guys, under the equity method, we said whatever the investee earn, our portion of the investee's stake, whatever they're earning, we're going to recognize it on our income statement right today. Because even if they're not giving us back as dividends, we have significant influence to go back later and collect it. But for the cash flow statement, we are only looking at how much have the dividends been received. Now here, the earnings from the investee equity in earnings is 25. And the investment on the asset side, investment in the investee account, that is also increased by 25. What that means is it seems that the investee paid out no dividends. Look at the journal entries here. The investment account increased by 25. So this is investment under the equity method. This increased by 25, and the credit equity in earnings also increased by 25. So there's no cash plug here, so no impact on your statement of cash flows. Next one, number 8, we're looking at tax. Now income tax expense on the income statement, that's 150. Now that relates to two of the balance sheet accounts that we've identified. It relates to the deferred tax liability. It says the deferred tax liability, that's decreased 25. And it also relates to taxes payable, which have increased by 100. So let's put all the changes there on the journal entry. So I'm looking at the 8th journal entry here. This is income tax expense number out here, that's 150. Now, deferred tax liability has decreased by 25. Deferred tax liability was a credit number. Decrease means debit. So DTL 25. Income tax payable has increased. That's a liability. An increase in liability means for the credited 100. So how much has the cash actually gone out? The income tax expense here, that's 150. But how much has the cash gone out? Because that's what I'm concerned about. Taxes paid, not incurred, paid. 150 plus 25, that's 175 minus 100 gives me 75. So that's the cash plug that I'm looking at from this journal entry, which flows in here. Now, looking at the 9th one, gain on sale of available for sale securities. Now guys, gain on sale, I told you, that would come under investing activities. So when we are buying investments, making investments, so that is a cash outflow. So cash outflow, we buy the investments. When we sell those investments and make gains, that's a cash inflow. So all the cash inflow that comes in, that might include gains and losses as well, goes into cash flow from investing activities. There's no impact on operating activities. In the operating activities, we're just looking at interest and dividends received from those investments, not the gain on sale of those investments. So I'll not do this journal entry at all, because right now we're just looking at the direct method for operating activities. So now, putting the numbers together, we got 1300, 525, 200, 100, 60, 75, all good. So this one is 1300. So all the cash inflow from operating activities, $1,300. Cash outflow, that's 960. What's the change? The change is $340. So then source of operating activities, cash inflow, 1300. Cash outflow, 960. Net increase in cash or net cash provided by operating activities, or the next net cash inflow from operating, $340. This is the direct method. Now, let's go to the book, look at the direct method journal entries, and we'll come back and I'll do the same problem using the indirect method. We're looking at direct method, pass journal entries and look at the cash plug. So looking at the first journal entry, sales was $1,500, but accounts receivable increased by $200. So the cash collections on sales, that was $1,300. So highlight cash, and that's your plug. Second journal entry, COGS was $500, but inventory increased by $75 and accounts payable increased by $50. So the cash plug was $525. So highlight cash on the credit. Third journal entry, you got payments for selling expenses. Selling expense on the income statement, that was $250. But allowance for uncollectible on the balance sheet, even that increased by $50. So the cash outflow from selling expense, that was $200. So highlight cash, and that's your plug here. The fourth journal entry, G&A expense, we could not find any balance sheet related account here. So G&A expense debit 100 and credit highlight cash. So all the cash went out was 100. Fifth journal entry, you got depreciation expense. Now that does not impact your cash account. Your journal entry is depreciation expense debit and the credit is accumulated depreciation. For the sixth journal entry, interest expense on the income statement, that was $75. But we had an amortization of bond discount in the balance sheet for $15. So the cash that went out towards this interest expense is $60. So highlight cash, and that's your plug number here. The seventh journal entry, we're looking at equity in earnings. Now we saw that the equity in earnings number on the income statement, that was $25. But the investment number on the balance sheet, even that increased by $25. So you could say that all the earnings of the investee was recognized as equity in earnings and there was no dividend received. So no cash inflow there. So look at the journal entry. Investment increased by 25. Equity in earnings, that was credit 25. No cash inflow during the period. Next, we're looking at income tax expense. So the number on your income statement is 150. But you saw that deferred tax liability decreased by 25. So debit 25. Income tax payable increased by 100. So credit of 100. And your net cash plug is $75. So on the credit there, highlight cash. And that's your plug number here. Now the cash proceeds from the sale of available for sale investment, that's a highlight investing activity. So the gain is a non-operating gain and not part of operating activities. So on the journal entries, you're going to having a cash inflow from the sale of investment and the gain on the sale. But that cash inflow is from investing activities. And right now in this section, we're just looking at operating activities. So look at the summary there, operating activities under the direct method. You've cash collected from customers, $1,300. You got payments for purchases, for selling expenses, for G&A, for interest and taxes. And this gives you, highlight net cash provided by operating activities and highlight $340. Now, as we know, the operating activity section, this can be presented either under the direct method, as we've done here, summary of the cash account, or the indirect method, which is a reconciliation approach. What you do there is you start from this net income number and then you make adjustments. We'll talk about 3 adjustments which help you get to this net cash flow from operating activities. So let's get started. So we have the direct method here. On the other side of the board, I'm going to do the indirect method. Again, we're looking at the statement of cash flows. And looking at the operating activities section. So the first number here is going to be the net income from the income statement. On the income statement, we have $350 net income. So that's your first number out here. Net income. Ideally, what we say here is, we think that all the income earned, most of it should be in cash. Let's say all the sales were in cash. All the purchases were in cash. So net income could reflect the